note yield reaction to today's numbers and the downward revisions, right? We're down like 22 basis points in the 2-year note. That means that the market said, well, I guess this is new information or newly estimated snapshot of the economy, and we have to react to it. If it were not considered to be the best possible guess that we have available to us, markets would probably ignore it.
No, I agree.
If it were not considered to be the best possible guess that we have available
from, and in particular, Chair Powell came across much more hawkish than most people expected on Wednesday, putting in doubt a September cut. So you had the initial conditions that led to a higher 2-year than would have been otherwise, and then you got not only a significant fall in the 3-month moving average of new jobs, but the unemployment rate is the highest since 2020. So, those of us who are arguing for a rate cut this week were worried about the underlying strength of the labor market. And where did we get that worry from? From talking to employers. Employers have become much more hesitant to employ people, and now it's starting to get picked up in the data.
Where do you think that leaves the Fed? I mean, obviously, they're going to have to take this into account here. Is there a way that this is just a stutter step in job growth, or it's a matter of reaction to the uncertainty overhang of tariffs that can soon be clarified?
I think if they knew then what they know now, we would have got a 25 basis point cut. That means a 25 basis point cut in September is highly likely. And then there's a possibility of something you just mentioned, which is what happened exactly a year ago. If you remember, exactly a year ago, there was no cut in July. Then we had a jumbo cut of 50 basis points in September. If we get another bad jobs report, we will be discussing 25 or 50 in September, 50 basis points in September.
Do you think that would
if we get another bad jobs report, we will be
get between now and then?
I think it will. I also think that there's starting to be more clarity that a stable inflation rate is somehow between 2.5 and 3. And what I suspect you'll see is Fed officials pushing back the 2% into another year. So we've already pushed it back quite a while. I mean, it's 4 years now that we've been running above 2%. It wouldn't surprise me if we run another 2 to 3 years above 2%.
Right. And that's not something that the Fed should necessarily react. What's your general sense of, wherever we can make an educated guess on where tariffs do settle out, what it's going to mean for the global economy? Because, we've seen recently the dollar rally again, maybe with the European 15% tariffs. It seems as if the relative growth rates maybe shifted back in favor of the U.S. At least we thought so. So how is that going to affect the overall system?
So I think there's only one thing you can say with a high level of confidence, which is the multi-decade convergence toward lower rates and more uniform rates. That convergence is over. We're now living in a world of higher rates, less predictable, and less uniform. Beyond that, there are major questions. I don't think today is a destination. I think today is another stop to an ultimate destination which is still uncertain in terms of the US tariff regime. There are lots of negotiations ongoing with major countries. In addition, we don't know how governments are going to respond. We don't know how companies are going to respond. And we don't know who's going to pay the cost of the higher tariffs. It will depend not only on the sector, but on the company in the sector. So there's lots of question marks. And I think the only thing we know is that we are in a different regime overall, but we still don't know what the exact destination looks like.
We don't. That has been elusive. At one point, we thought it was going to be, July 2nd and then August 1st, and it keeps getting pushed. We'll see. Mohammed, great to have you. Good to talk to you. Have a good weekend.
Thank you, Mike.
All right, let's send it over to Christina Partsinevelos, who is tracking some bright spots in a down tape. Hi, Christina.
Hi, and that's why I'm wearing this jacket today. Figma jumping 2% higher in only its second day as a publicly traded company. The design software startup shares more than tripled yesterday on their New York Stock Exchange debut. You can see actually inching closer to 3% higher. Falling interest rates helping home builder names rally, even after President Trump announced, like you guys talked about, another round of tariffs. Top performing names include D.R. Horton, Lennar, and Pulte Group, as investors bet that lower borrowing costs could offset potential tariff headwinds. And speaking of tariffs, First Solar expects its prices to actually increase because of those new levies on foreign-made solar panels. But the company's raised annual sales forecast is what is actually driving this name higher today, almost 7% higher, Mike.
All right. It's a jumpy one, this time to the upside. Thank you, Christina. We are just getting started. Coming up, much more on today's sell-off. Apple under pressure despite reporting a strong earnings number. Star Apple analyst Eric Woodring standing by with his first reaction. We are live from the New York Stock Exchange. S&P down 1.6%. You're watching Closing Bell on CNBC. Shares of Apple lower amid the broader market sell-off despite a Q3 earnings beat last night from the company. Joining me now to discuss the print is Morgan Stanley's Eric Woodring. Eric, great to have you on. I wonder if, first of all, you just give me your sense of why the stock is reacting. Obviously, it's a sloppy tape, but if there's something your clients are suggesting gave them pause.
Sure. Hey, Mike, thank you for having me on. So if we take a step back, I actually thought this was one of Apple's more impressive earnings prints in quite some time. You got upside to the June quarter results, even when you take away the fact that there was some pull forward and maybe some one-time benefit from discounting in China. Services was very strong. That was a key sticking point leading up into the quarter. Obviously, that accelerated. Gross margins were strong, and frankly, the guide for the September quarter was much better than expected. So all across the board, again, overall stronger than expected. I think the areas where maybe there's some nitpicking is there was some pull forward that benefited the June quarter. As we know, September is typically the quarter that Apple launches its new phone, and therefore it's really a sell-in quarter. And so the September quarter guide is maybe a bit more reflective of sell-in as opposed to sell-through. But really, when we take a step back, I think what we've heard this week and maybe over the last 2 weeks has been rhetoric more concentrated around tariffs. And as you know, right now, Apple has exemptions on tariffs for most of their main products, but Section 232 tariffs do pose a threat, and they are imminent. We would say if there's a, call it 15% tariff on semiconductor content for a company like Apple, that could be on an annualized basis something like a 200 to maybe 250 basis point headwind to gross margins. That's almost a 10% EPS headwind. So just to put things in context, my numbers went up 3 to 4% overnight. But that looming threat of tariffs still stands, and I think the market is very focused on that point because they are so imminent.
Tim Cook had a lot to say, at least in general terms, about AI and Apple's commitment to it. Also expressed a willingness to do more M&A. Is that satisfying investors right now?
I think it helps move the needle in the right direction, quite frankly. I think there's more that needs to be done, especially I think we need to learn a bit more about Apple's strategy really around building versus buying versus partnering. But the rhetoric around increasing AI investments, I think that's what the market wants to hear. Again, it's completely different than what we hear from the rest of the Mag 7, right? Apple's spending $3.4 billion per quarter on CapEx, not $20 billion plus. But that 3.4 is up from 2.9 2 quarters ago, and it is trending higher. So Apple's spending, I think investors like to see that. And then Tim, acknowledging that they are open to M&A, while I might not necessarily think that's going to be a lever they pull, at least shows that he's willing to consider a multitude of options to make sure that Apple presses forward on their AI strategy. Again, I think that optionality is what investors want to hear. So we took the proper steps forward. Still, clarity still needed. But that was probably the most transparent I thought Apple has been about AI on an earnings call, probably ever, quite frankly.
Yeah, we'll see. As you mentioned, there's a couple other potential catalysts or points of clarification coming up in this story. Your target 240. We'll see how it goes. Eric, thank you very much.
Thanks so much for having me, Mike.
All right, up next, the Dean of Valuation, Aswath Damodaran, is back. His take on today's big sell-off and where he sees tech valuations heading from here. Closing bell, be right back.
Have you ever
There's some breaking news out of the Fed. Steve Leisman here with that. Steve.
Adriana Kugler, the Federal Reserve Governor, announcing her resignation as of August 8th, 2025. Adriana Kugler was appointed, nominated by President Biden in April of 2022. She will have served about 3 1/3 years on the Federal Reserve Board, 3.5 years. And she is announcing her resignation to go back to Georgetown. This is a fairly normal thing that we've seen professors leave for a period of 2 or 3 years and then return back to the university. Rick Mishkin comes to mind. Richard Clarida from PIMCO, he went and went back after about 3 or 4 years on the Federal Reserve. But obviously, this is a time where the Federal Reserve is fraught with political intrigue in the sense that this does open up a spot for President Trump earlier than had been expected. Her term normally was going to expire in January, but she's leaving now in order to go back for the beginning of the fall semester in Georgetown. Guys?
All right, Steve, thank you. Well, it's been an ugly day for stocks as we kick off August, trading deep in the red. Here to discuss it is NYU Stern School of Business professor Aswath Damodaran. It's great to have you, Aswath. I mean, coming into this period after this very strong run we've had over, say, 3 or 4 months, did the market as a whole have a valuation problem, or did it really, change the risk reward looking forward?
I think the market has been bimodal. The first part of the year, I think the market built in expectations that things would get a lot worse. Then in the last 3 months, it almost seemed to switch and go in the other direction. The truth, I think, lies somewhere in the middle. And I think we're going to find out over the next 2 or 3 months where that steady state is. But I do think markets got a little overstretched over the last 3 months, expecting the best of things.
All right. And were there parts of the market that you felt as if just got either, overdone or were left behind? But, many of us keep talking about how it's in some respects an unbalanced market, just in terms of the massing of market cap in one area and in the kind of secular growth parts of this market. And yet those secular growth parts of the market is where all of the upward earnings expectations have been as well.
I mean, if you look through April 8th, the Mag 7 stocks lost almost, 20% of their market cap, trillions of dollars in market cap. What's happened in the last 3 months is not only have they recovered that loss, but they've added another couple of trillion. The key word is trillion. I mean, we're adding magnitudes of value to these stocks that I don't think they can sustain given the economy, given the company's own capacity to generate earnings and cash flows. So that's what I mean by overstretched. I think that, these are great companies, but they're not as great as the market thinks they are in terms of what they're bidding up the market cap to.
You mentioned that by most lights, I suppose, the economy had been holding up better than many would have expected, given the tariff overhang and even the tariffs that already have been imposed. Does that still seem to be the case in light of today's jobs numbers and some of the consumer spending data we got this week?
I think here again, the market was never as bad as the economy was not as bad as people thought it was going to be on April 8th. And it was never going to be as good as people thought it was even last week or earlier this week. So I think we're going to get more reports like this where we go back and forth between the optimists who say, hey, this is going to be okay, and the pessimists who think that this is just front-running what's coming with tariffs, and you're going to see a much slower economy in the rest of the year. And you're going to see these reports come back and forth, and the market is going to be whipsawed every time a report comes out in terms of whether it's good news or bad news.
I'm fascinated by, you mentioned that just the trillions of dollars in market cap that have been kind of added to and occasionally subtracted from that small group of stocks. When it comes to NVIDIA in particular, which did peak at around a $4.4 trillion valuation before this little pullback, I mean, the volume of dollars added to the top and bottom line by this company is I think, unprecedented in this short period of time. It's going to be $250 billion in revenue next year, it appears, and about half of that falling to the bottom line. Is this the kind of thing? I mean, how do you treat that in terms of, do we extrapolate that as the run rate? Do you give it a premium for that, or do you assume that it's going to have to just revert to the mean?
Oh, we're not just giving a premium, we're giving a super premium to it right
Yeah.
now. I think nobody is contesting the fact that NVIDIA is an amazing company. Jensen Huang is a great CEO. I think the question is, how great is he and how amazing is it? Because what the market is doing is building into the market cap, I think, expectations that are going to be really, really, really difficult for even NVIDIA to meet.
Yes, and in fact, there's going to also be a time when I think investors are going to have to ask, what are you going to do with all the cash and the free cash flow, and can you deploy that in a profitable, high return way? We did get another pretty enthusiastically received IPO, the software company Figma, yesterday. I don't think the overall market has certainly had a supplied problem in terms of lots of new issuance, but there have been pockets of exuberance that have seized on some of these new ideas. How do you filter that into your view of the market environment?
Well, I'm going to go back to 2022 when risk capital left the market. In what sense? IPOs stopped. People were not willing to buy high yield bonds. In 2023 and 2024, the market came back, but risk capital didn't really make its way back. It just parked its money in the big tech companies and wasn't willing to buy into IPOs. I think the story with Figma is less about the company itself and more about the opening of the door perhaps to more IPOs coming out. And you're right, they're going to be concentrated in the buzzy areas. A lot of AI IPOs are probably waiting to see how Figma does. And given how well it's done the last couple of days, I wouldn't be surprised to see a lot more IPOs hit the market in the next few months.
Which is the kind of thing, I suppose, in a bull market that is sort of an energizing factor initially until perhaps it gets to get overdone.
Exactly. And that's, I think, the question is, as you see these new IPOs come out, how much will they stretch the market? Because, one of the signs of market exuberance is when you see IPOs of companies with no business models and essentially potential that is not there, and they get bid up just because they're in the right space. So it'll be interesting to see what happens in the next couple of months. But you know what? A market correction in the next few weeks will very quickly put that IPO market to sleep again.
Yeah, not to mention, August is often slow, so maybe we'll kind of reset ahead of any issuance boom that we may get. Aswath, great to speak with you. Thank you very much.
Thank you. Appreciate it.
All right, up next, we are tracking the biggest movers as we head into the close. Christina has those for us.
We have a shipping giant warning it can't see clearly enough to give guidance, and healthcare giant trading at 5-year lows after its second leadership shakeup in months. We're going to be looking at those week-to-date declines. Details next.
Coming up on 18 minutes until the closing bell, let's get back to Christina for a look at some of the week's biggest movers. Christina.
Yeah, I want to start with the big movers this week, and that would be United Health, down about 16% on the week, trading at levels we just haven't seen in 5 years after naming a new CFO just yesterday. It's the second major leadership change since May. Meantime, Coinbase has struggled, particularly after reporting a revenue miss in its earnings report yesterday. The crypto exchange saw lower than expected trading volumes, subscription revenues also lower, and transaction revenues lower in the prior quarter. It's now also the worst week of the year for the stock, trading about 19% lower on the week. And then lastly, UPS also falling almost 19% this week after it reported mixed quarterly results, earnings per share missing the mark, and a decline in average daily domestic package volume also hitting shares. The shipping giant warned that economic visibility was still too poor to provide guidance. So they opted out of guiding, and that's why you're seeing the stock hit so badly this week. Mike?
All right, yeah, some extreme news moves and some big companies. Christina, thank you. Quick check on the markets now as we head into break. You see the Dow, it is off about 571 points. The S&P down 1.6%. Has bounced a couple of times off that 6,200 level or thereabouts over the course of the day. We're going to have much more reaction to today's massive market move coming up. Closing bell, be right back.
Seven.
Up next, our Closing Bell All-Star panel standing by to break down the final moments of the trading day, including
Now you guys are back
John
together.
Colovis on why he thinks the market is approaching an inflection point. The Market Zone is next. We are now in the Closing Bell Market Zone, and we are all over today's big market sell-off. HSBC's Max Kettner and John Colovis from Macro Risk Advisors here to help break down the final moments of the trading day. It's great to have you both. John, tee us up here in terms of, what field position you think the market was starting this month from. I know you thought that maybe the rally was culminating. What are you seeing in today's action?
Yeah, I think, Mike, we're in the early stages of the corrective process here right now for the equity markets. Like you said, the setup was there, momentum was overbought, complacent sentiment, seasonalities, valuation, you name it. But today we really got a strong whiff of supply coming into the tape. The gap lower in the S&P today undercut short-term moving averages, and what it did was it created an island reversal. And when those happen, when you follow the charts, you got to take pause and turn down the volume. But what really stands out in today's statistics is that there was a big spike in 20-day lows to 40%. When you go about 2 to 3 months without a big spike in new lows, and then when you get it, that's either at the very beginnings of the topping process or at literally the beginning of the decline itself. So we saw that in December of last year. Market went sideways and then rolled over. And then we saw it exactly when the market decided to fall apart in late February, early March. So I think that we're in the beginnings of the corrective process. how the market behaves around this 6,200 level will be important. If we break it hard, then I think it's going to be more of a direct move lower, not only to the 50, but we'll probably make a run towards the 200 at around 6,000. If it's more of a benign break, yeah, it'll probably be more of a churn sideways sort of thing. But overall, I'm viewing this more as a pullback within an ongoing bull market. Still think 6,600 before the end of the year.
All right, and Max, I mean, are you newly focused on the potential for downside risk? And did the fundamental story shift at all for you today, either with the jobs number, with yesterday's personal spending, or anything else that hit this week?
Yeah, look, when we look at the earnings numbers this week, actually, I mean, the earnings numbers look pretty good. So from that perspective, actually, not an awful lot has changed. I would say, indeed, when we look at some of the big AIs, some of the tech names, their reporting was very, very strong. And of course, we are still seeing very, very strong AI CapEx spending numbers as well. So I do think bottom up, also the AI story is still very, very much intact. That should be helping, particularly the US equity market. Obviously, the weaker dollar should still be helping also US earnings, and particularly the mega cap earnings. So from that angle, I don't think an awful lot has changed. I think the labor market today really was a bit of a shocker, right? Like, let's be honest, when we look at those kind of revisions, these are sort of the revisions that we were used to during peak lockdown 5 years ago and during COVID, but not during normal times. It raises, of course, also the question around data quality. It raises the question whether both us as analysts, but also policymakers, are now being at risk of sort of making policy decisions or making recommendations on the basis of, I wouldn't say false data, but really data that are heavily prone to revisions. That is, I think an ongoing question, particularly with the cuts to funding of agencies like the BLS. But I do think what it also does going forward, it does actually lower the bar, number one, for perhaps some of that hiring coming back, right? That is number one, with a bit of more clarity now around trade policy. When we think about, the Japan deal, the EU deal, perhaps a bit more positive news around the China deal as well. So that should give a bit more clarity to companies. That should also perhaps give a bit more confidence back in terms of hiring. And it should also give a bit more confidence in terms of investment, in terms of a bit of a comeback for investment in the second half. Both of these things are actually still things that keep me pretty bullish.
And I guess, Max, you're talking in particular about just the challenges to data collection and the lower survey rates, and maybe there was this, sort of leaving the numbers more susceptible to revision, not what we heard about this afternoon about the president potentially firing the head of the statistical agency.
Yeah, I think that's more that one. It's not really related to firing the head of the agency. Yeah. It's more perhaps around, staff shortage as well, right? That basically, I think in the BLS, the cuts to staffs was around 8%. That was in the original bill. All of that obviously doesn't help in terms of data quality and data collection. That is something that we really need to be mindful, I think, in the next, not only in the next month or two, but really in the next couple of quarters. And does that make us more susceptible to very, very wild swings in terms of revisions, and does that make us susceptible also, again, to make sort of recommendations on data that is heavily prone to revisions, and also policy decisions, and also policy pricing, which also introduces sort of quite unwarranted volatility in markets then, of course.
And speaking, John, of volatility in markets, I mean, even though we're like less than 3% from the highs in the S&P, and as I mentioned earlier, the markets tried to bounce off of 6,200 a couple of times today. The volatility index has had a bit of a pop. It's up 4 points. It's above 20 again. Is that telling you something about, whether it's a change in character of the market, or does this rush to hedge mean that we're just kind of rebuilding the wall of worry and we're going to give way to another dip buying and rotational type tape?
Yeah, it's great to see VIX finally do something. I mean, clients today were very excited to see the action within the VIX. I think what it's reflecting here is not only just a growth scare in the market, but what you guys were hinting on a second ago, about Trump trying to fire people. It's just not a good look. So what it's doing is it's bleeding into credit spreads spiking today, and I think that's an important consideration. It will be a change of character to your point. If it persists, if the CDX spreads, they're already spiking today, and we see follow through on that, it's going to bleed into the equity markets. And my idea of it holding 6,000 might not happen if we see continued acceleration within credit spreads. So financial conditions have been fantastic all year. That has to stay, because that's really the main point here for all of us. Whether you're bullish or not, so those credit spreads really do need to can control and stay down.
Mm-hmm. Max, you certainly note that the actual earnings performance has been quite strong, and big beat rates and a wide margin of outperformance by most companies. What do you take away from the fact that the market as a whole hasn't really been able to pull any strength from all that?
Yeah, look, I guess there's been, of course, also some of the not very supportive political news. Think about yesterday around the healthcare sector, of course. That's been overshadowing, or more than overshadowing, the good numbers from Meta that we had, for example, also from Microsoft. So I do think it's not just about, okay, the market's not gone up. Why is it not gone up? So definitely the market is not rewarding any of these earnings beats. No, that's not the case. I think it's just that those single name stories, or those political stories that have been flaring up over the last couple of days, they've been sort of overshadowing it. Is that really going to continue? To your guys' points around credit spreads, I'm very skeptical around credit spreads really blowing up much further. I am much more sanguine about that in terms of credit spreads as well, because the technical picture, particularly in US credit, particularly around default rates, both in Euro credit and US credit actually, but also around refinancing needs, around the maturity wall, around index credit quality, all of these things are so much better. So that leaves us with a technical picture, particularly in credit, both in IG and in high yield, so much better compared to 10, 15 years ago. And that really should be somewhat softening the blow, I think, in terms of credit spread widening in the next couple of days and weeks.
Yeah, a lot of talk about how the private markets have taken away some of the more suspect paper, and we have a bond market that's in better shape. And speaking of bonds, John, the Treasury bid today has been very strong. Yields have come in. Do you see anything there that's telling us about how that's going to go in the future? Can you actually, hide in Treasuries for a bit?
You probably could a little bit. The trend really has been sideways for the 10-year, stuck between that 465 and that 410 area. But today's move, I think at a minimum, tells us we're not going to see 4.5 anytime soon. And same with on the short end of the curve. Now, the short end of the curve looks as though it's going to be capped, underneath that 390. My sense is once we see a clean break of the July lows on the 2-year, we'll get down to around 3.5. So yeah, I do think that the short end of the curve it's going to work itself lower in terms of yields. But yeah, heck of a move today, an outlier move, and you got to respect it.
Gotcha. John, Max, really appreciate the time today. Have a good weekend as we head into the close. The S&P 500 is still sitting on about a 1.6% loss for the day. It's been around that area for a while. It did bounce up 6,200. That was the low from last month. The small cap Russell 2000 down 2%, bearing the brunt of that bad job support. Does it the closing bell now. Let's send it over to overtime with Morgan and John.
Well, that's the end of regulation. AB InBev bringing the closing bell at the New York Stock Exchange. The Chicago Innovation Award winners doing the honors at the NASDAQ. This was not a sleepy summer Friday, folks. Stocks in the red. Down day for the major averages. It was a down week, worst week for the S&P and the NASDAQ since May, for the Dow since April. Tech earnings, tariffs, job numbers, political firing, all conspiring to send stocks lower on this Friday. The NASDAQ with the worst day in 3 months. The S&P 500 with its first 1% move in either direction in more than a month today, lower. Bond yields falling sharply, though, on the weaker than expected jobs report. And Amazon down big following its results. Apple also lower on the day.
That is the scorecard on Wall Street, but winners stay late. Welcome to Closing Bell Overtime. I'm John Fort alongside Morgan Brennan. And let's get straight to the numbers. A lot of focus was on tech results this week, but Christina Partsinevelos is looking at the other sectors that were hit hard. Christina?
Yeah, so much for that chill summer Friday vibe, John. Markets just delivered their worst selling day in over a month. You mentioned that, with all major averages closing lower this week after 2 solid weeks of gains. Small caps taking the biggest hit, with the Russell 2000 down more than 4% on the week. Escalating tariff cost pressure these domestically focused companies that struggle more with rising input costs. So that's why you're seeing that lower. Materials led the weekly decline, closing over 5% lower. Eastman Chemical actually plummeted. That's the big name this week, plummeting over 20% today after missing earnings and slashing guidance, citing that difficult macro environment that we hear so much about. Consumer discretionary wasn't too far behind, over 4% lower, followed by financials. Bank stocks really came under pressure as we talked about softening labor data, just really awakened fresh concerns about economic strength. Even crypto, though, couldn't escape today. Bitcoin dropping more than 3%, the lowest level in just 3 weeks at under, you can see trading at $113,000, dragging down Coinbase, the usuals, Riot Platform, MicroStrategy. Coinbase, though, posted its worst day since March after missing second quarter revenue. You can see Coin down 16% today. Healthcare provided one of the few bright spots. That would be the entire sector, though United Healthcare is did trade at levels not seen in the last 5 years, closing almost 5% lower after naming a new CFO. This is the second major leadership change since May. Morgan, lots of changes.
Lots of changes. Christina Parsonavelos, thank you. Now let's turn to the bond market because we saw a big reaction in yields to this morning's jobs report, 25 basis point move on the 2-year. Which, of course, is tied to the Fed and Fed rate decisions. Rick Santelli is joining us from Chicago to break it down. Rick.
Yes, and you nailed it. I'll show that same chart again. Wow. If you look at the intraday chart, it was straight down. It was straight down on 2s and 10s, but 2s in particular. Look at the weekly chart of 2s and 10s, and you can see the blue line is 2-year yields. They've definitely been leading the way. We're down 27 basis points on the day, and at 267, we're down 26 basis points on the week. There's not many weeks you could say that, and maybe deservedly so. Weak jobs report, very nervous headlines about geopolitics. But there's one thing in particular that I was paying attention to when I brought the number out at 8:30 Eastern, and that was 258,000 revision to the downside, 2-month revision. Let's go to the chart, shall we? 2-month revision on non-farm, 258,000. That is the biggest since the depths of COVID, since May of 2020, which followed some of the biggest moves in non-farm payroll in history because of the volatility on COVID. So we can all talk about who's getting fired, who isn't getting fired, the accuracy of surveys, but you can't cheat the charts. It was a huge revision, a shockingly huge revision. It really makes many market participants scratch their heads. How can you trade on any types of survey data when you take so much of it back months later? So the issue is a hot one with traders, but in the end, that 2s-10 spread just today alone steepened 11 basis points, and we've been talking for a year that you don't want to fade a steep yield curve because even when rates look like they're going to come down, it takes one pop in data to steepen that curve. John Fort, back to you.
Rick Santelli, thank you. A lot of questions about what's real with the data and why. Blunt reaction to those job numbers from the White House. President Trump firing the person he deems responsible for the numbers. Our Eamon Javers joining us now from Washington. Eamon?
Yeah, John, just within the past couple of minutes, we've seen a new post here after announcing the firing of the Commissioner of Labor Statistics. President Trump posting again to social media just in the past few minutes here saying, quote, "In my opinion, today's jobs numbers were rigged in order to make the Republicans and me look bad. Just like when they had 3 great days around the 2024 presidential election, and then those numbers were taken away on November 15th, 2024, right after the election, when the jobs numbers were massively revised downward, making a correction over 818,000 jobs, a total scam. Jerome Too Late Powell is no better, but the good news is our country is doing great." And President Trump's labor secretary posting on social media that she supports the president's decision to fire the commissioner of the Bureau of Labor Statistics. She writes, "I agree wholeheartedly with @POTUS that our jobs number must be fair, accurate, and never manipulated for political purposes. A recent string of major revisions have come to light and raised concerns about decisions being made by the Biden-appointed labor commissioner. I support the president's decision to replace Biden's commissioner." And a White House official tells our Megan Casella that the White House believes the president 100% has the legal authority to fire this official, and that the reason for the firing is the scale of those jobs revisions that we've seen in recent months. The White House also saying they will get, quote, "someone competent to do the job in the future," but no immediate indication of who the long-term replacement will be. In the meantime, the administration says the Deputy Commissioner of Labor Statistics will serve in an acting capacity during a search, John.
All right, Eamon Chavers, thank you. We got a lot to digest today. So let's bring in Unlimited CEO and CIO Bob Elliott and Farr Miller, Washington President and CEO Michael Farr. He's also a CNBC contributor. Gentlemen, it's good to have you. Bob, you're here with us on set. I'm going to kick this off with you because it's a perfect storm. You've got tariff implementation. You've got a very weak jobs report, this BLS firing, and then, of course, in the background, amid this Russia rhetoric, nuclear subs that are being repositioned to quote-unquote appropriate regions. Couple it with some seasonality. Is this to be expected today?
Well, I think we're basically seeing the market realize that the economy is quite a bit weaker than is currently priced into the markets. Like if you look at the bond yields before today, and you look at equity markets before today, we were basically at all-time highs in terms of stocks, and basically at cyclical highs in terms of yields. And the reality is there's been a building consensus of data highlighting the fact that the economy is slowing down. And I think in many ways, the jobs numbers today just sort of crystallized the reality that most people already knew if you were looking broadly at the data at hand.
Yeah. Michael Farr, does this set the table for a September rate cut, especially when you see the big move that Rick Santelli just outlined in bonds today?
I think that this is the plank that people are using to really strengthen their argument that we need those cuts. Things do look weaker. This employment data is coming out as weaker. And Jay Powell, I think the key here, Morgan, is that Jay Powell is not yet convinced. Jay Powell is still saying, look, you had 37% increase in imports in the first quarter, 30% decrease in the second quarter. That was a front loading and a wash. We have to see if tariffs are really going to slow the economy further or whether they're going to add to inflation. So everybody sees the stag part of the stagflation argument. And Jay Powell is saying, wait, I can't just raise rates into an inflationary environment until I see the whites of its eyes. But he sure isn't going to cut rates here. So I think the market, in anticipating a rate cut, is getting ahead of itself and beginning to listen to its own narrative a bit. I don't think Powell is convinced.
Bob, curious your take on some of this data stuff. Data, really important for everybody to be able to trade on, to understand. It looks like federal employment was a big part of the revisions here. We all know what's been happening with Doge this year.
The market is
and
closed.
That hasn't happened before, so I imagine that's going to be hard to forecast. Also, I got questions about how much immigration, illegal immigration, the crackdown on that might be having an impact on these numbers. To what extent is this just a time of great change where it's difficult to forecast? If so, how should investors factor that in to how they plan things going forward?
Well, I think the revisions process with the payrolls report has always been sort of fraught with trouble in the sense of there's always a series of revisions that happen the next month and the next month, and then a bigger revision that almost typically happens, 9 to 12 months later. And so what we're seeing here in terms of these revisions are not all that unusual relative to the typical noise that we see, particularly in slowing environments. By definition, and process these payroll statistics, they sort of take longer moving averages. And so if we start to see a more abrupt deterioration, for instance, like we saw back in the 2008 period, often the initial reads will be a little lagging relative to the final reads. And I think that's basically what you're seeing here today. The good thing is, look, the president can fire the head of the BLS. They can engage in political manipulation around these statistics. The good thing is that there's a wealth of labor data that's out there in the market that's not reliant on political appointees and their belief in, holding up statistical standards. And so to the extent that the labor statistics, the payrolls get politicized, people will look at those other data from other areas, from other payroll providers, for instance, like ADP, and start to benchmark on those. And so regardless of whether or not those data get manipulated, the truth will be known, and the market will trade on the truth much more than whatever is reported by the government if it comes to be that case.
Challenging. Michael Farr, does this put the soft data in perhaps a different light, or perhaps it's a different value on it than we might have thought there was a couple months ago when we were wondering hard data versus soft data, which is more predictive of where we're headed?
Yeah, first, I think Bob's got this exactly right. I agree with him. And yeah, the hard data and the soft data is left to some interpretation. And the bulls want to interpret it their way, and the bears want to interpret it their way. I think the big mistake that markets may have made over the past 5 years with the Federal Reserve is coming up with its own narrative. Markets are looking for the cuts. Markets are looking for the Fed to get in and intervene and make everything okay again. And Jay Powell, who doesn't have to keep his job much longer than 6 months, I think is being very circumspect and saying, hang on. So I think the real risk here is that markets are going to build an enthusiasm around a cutting narrative that may not come to pass. So you really need to pay attention to valuations. You really need to pay attention to the cost of money vis-a-vis interest rates, and really what these earnings continue to produce, and listen to the early messaging from a lot of the corporate CEOs about the challenges they're facing in order to produce and keep up profits in a time of increasing tariffs.
All right. Michael Farr, Bob Elliott, thanks to you both. Coming up, a late Friday bombshell from the White House. The president unhappy with the jobs numbers, particularly those revisions, firing the person in charge. We're going to talk about the impact of that move.
And check out shares of Fluor. Those are losing nearly 30% of their value today after missing on earnings, cutting guidance. That's having a big impact on NuScale Power. Fluor says it will convert shares it owns in NuScale, which could eventually mean Fluor would have to sell them. We've got much more on today's big market moves coming up. But just to put this in perspective, when you see names like this, moving like this, it speaks to how volatile the day was.
Welcome back to Overtime. It's a sell-off Friday after this morning's jobs report. 73,000 jobs added, well below the estimate of 100,000. But even bigger, major revisions to May and June. June jobs growth revised down to 14,000 from 147,000. And May jobs growth down to 19,000 from 125. And those revisions caught the eye of President Trump. This afternoon, he ordered the firing of the Bureau of Labor Statistics Commissioner, saying she is a Biden political appointee manipulating jobs data. Joining us now is Neil Dutta from Renaissance Macro Research and our Steve Leisman, CNBC's senior economics reporter. Steve, put the data, the revisions, and this firing into context for us, if you will, particularly the difference between the initial read and the sampling there, and then what happens when these numbers get revised. Why would there be such a huge revision over a period that clearly has been full of economic turmoil?
Well, I'll tell you what's been happening, and just by way of background, there are essentially 3 revisions to each number. It's revised, it comes out the first time, it's revised the next month, and it's revised the third month. It then sits there until a benchmark revision comes along. Let me talk about the first set of revisions over the first 3 months. The BLS gets information from establishments for its payroll survey, and they basically write in, or the BLS writes them and say, hey, tell us. And what's been happening is those response rates have been coming down. So a little bit more, somewhat more of the initial month, and then the second month and the third month end up being a little bit more estimates until over time it's trued up. It's trued up eventually with state payroll tax insurance data over time, and then you have a more precise thing. So it's like 6 months after the end of the prior year, they then true it up. The president, as far as I can tell, is simply wrong in his tweet that Eamon Javers just read, saying that the 818,000 revision came out after the election. I have now, I think, triple checked this. The 818,000 revision, Mr. President, that came out, that you say came out after the election, came out in August 2024. You can check the records on that at the BLS, when the BLS announced that it would be revising down on a final basis in January of 2025 the prior year's payrolls by 818,000. That was known to the public, known to the street in August of 2024. And then he talked about having 3 good months that were revised away. They were modestly revised. Overall, there are problems, John, and the problems are that the response rate since the pandemic has been coming down.
Interesting.
And I don't know exactly what the BLS is doing to address that. It needs to be addressed. It means that the first month is less reliable. It means revisions have gone up, and these past 2 months have been large revisions. There is, however, seems to be a baseless charge to me, where the president is perhaps misinformed on this, that there are politics behind it.
Well, someone else is going to be handling that one way or another, it seems. Neil Dutta, what do you make of what we got in the data today, the best data that we have at the moment anyway, and what investors should really take away from it about the state of this economy and the market?
Well, I think for the Fed, it feels a little bit like deja vu all over again, because this is kind of where we were around the same time last year. Things sort of seem okay, and then you kind of get punched in the face with a weak jobs number. And, make no mistake, the jobs number was weak. It wasn't just about the revisions, which tend to be cyclical in nature historically, right? So in good economies, data tends to get revised up. In bad economies, data tends to get revised down. But I think what's important is that the prime age employment rate, so those aged 25 to 54, that employment rate is down about 0.5 percentage point against last year. That is not typical for a good economy. There's been a lot of kind of rationalization away of the jobs number. Well, it could be immigration and so forth. If you look at college unemployment rates, they're clearly going higher. I mean, so to me, like using immigration as a rationale to kind of wish cast away the jobs data, I think is a mistake. So, to me, the Fed is in a pickle, I think, because inflation numbers might get a little worse over the summer. But ultimately, for me, it's about the nominal anchor. And it's pretty clear that nominal incomes are slowing. And so I think Governor Waller, as an example, is on very, very solid ground. Ultimately, I don't think consumers really have the capacity to absorb higher prices. And as a result, I think the Fed's going to be cutting in September.
Yeah, of course, it was interesting to get those statements from Waller and Bowman today on the heels of that data. Neil, I mean, just to put a finer point on it then, if you have a labor market that's weakening, and if it continues to weaken, doesn't that actually mean slower consumption, which in turn slows the economy and ultimately could slow the pace of price increases?
Well, we've already had slower consumption. I mean, that's the sort of nasty little secret. If you look at the first 6 months of this year, real personal consumption is actually down, okay? That's not widely known, but you have basically, I think, 3 economies, Morgan. You have housing, which I think is in recession. Single-family permits are down quite sharply. The consumer is, on very, very thin ice. Real spending is down. Even in services, by the way, it's weakening quite notably. You can't really shift that around because of tariffs. And then, on the final piece of it is this AI boom, which has been spectacular. But ultimately, I think broad CapEx outside of AI tech, that's going to be sluggish because ultimately, if companies feel less good about the outlook, they tend to spend and invest less. So that's what I anticipate going forward.
And of course, maybe that speaks perhaps to college grads and the unemployment rate there. We have to leave the conversation there. Gentlemen, thanks for joining us. Neil Dutta and our own Steve Leisman. Well, coming up on Overtime, stocks selling off today, but that's following a huge run to record levels over the last couple of months. But as the weather gets hot in August, should we expect the markets to cool off even further?
And news on Tesla that could be a speed bump for the company's autopilot ambitions. Stay with us. Welcome back to Overtime. A Florida jury ruling Tesla was partially at fault for a deadly 2019 crash involving autopilot. The jury awarding the plaintiffs $329 million in damages. The 2019 crash, which killed one pedestrian and injured another, occurred when the Tesla ran through a stop sign. Tesla says the verdict is wrong, says the driver was completely at fault for having his foot on the accelerator, which overrode autopilot and took his eyes off the road to look for his phone. Tesla CEO Elon Musk saying Tesla will appeal, and the stock was down today less than the NASDAQ.
All right, well, now let's bring in senior markets commentator Mike Santoli to point us to key levels to watch as we head into next week. Mike, what are you watching?
Yeah, Morgan, so the S&P 500, it's down less than 3% from its highs, but it did take us back to a couple of weeks ago, so it sort of wiped out, let's say, 10 days worth of gains toward those record levels. Now, if we're looking at what maybe some logical downside targets would be if the pressure continues, a lot of focus right here, like this 6150 type area. We bounced off 6200 or 6210 a couple times today. That's the prior high from February. Other things, that basically it's sort of the upper range we've been in the latter part of the summer. Also, the 50-day moving average, not shown here. It's like 61 30. So if it were to, go a little while longer before we got to it, it would be around that level. So that's a clustering of potential support. So that's the way traders would think about this at this point. Obviously, in a one-year chart, the pullback doesn't look like too much just yet. Now, we also, as has been remarked on constantly, entering this typically tougher seasonal period. So what this chart shows is at every point on this curve, what it's showing you is the average forward 3-month returns of the S&P 500. So the best moment in the year to buy stocks for 3-month returns historically has been right there. It's basically late October or so. So where are we now? Well, right here. On average, 3-month returns looking forward from here are actually slightly negative or flattish. Now, tons of variation around the averages, of course. And so even when we've had a strong trend going into August, you typically don't get as much of those downside pullbacks, or at least not as deep. So it's one of those things you keep in mind as one of the atmospheric factors bearing on things. And, it almost seems too cute that right here on August 1st, we start to get some of that weakness, but we'll see if it feeds on itself, Morgan.
Yeah, there had been some chatter coming into the end of July, and of course now the fact that we're August 1st, that it looked like month-end rebalancing was going to show the significant need to sell equities and to rotate into fixed income. I wonder if that's factoring in here, too.
I mean, you would think most of that would be done. It may be a background factor, coming into it because, even before today, below the surface, there was a little bit of loss of momentum in stocks. And, of course, Treasury yields were kind of off the boil a little bit. So I think that some of those mechanical factors matter. One thing charts do is they are a picture of crowd psychology and sort of human nature and behavior. And so even though it seems silly, if everybody knows August is weak, why are we even, why does it perpetuate itself? Shouldn't that be arbitraged away? Well, sometimes it's just the way the crowd reacts to the expected happening. We'll see if it holds up this year.
All right. We'll continue to watch your charts. Mike Santoli, thanks. Well, time for a CNBC News update now with Leslie Pickett. Leslie.
Hey, John. Ghislaine Maxwell, the former girlfriend of convicted sex trafficker Jeffrey Epstein, has been transferred from Florida to a minimum security federal prison camp in Bryan, Texas. Prison officials did not comment on why the transfer took place. Maxwell has recently spoken with the Justice Department's Deputy Attorney General, and the House Oversight Committee says it wants her to testify amid demands for the Trump administration to release the files from the Jeffrey Epstein investigation. Blackstone says it will reopen its Park Avenue offices on Monday, a week after a gunman carried out an attack in the building. The victims included Blackstone executive Wesley LePatner. The company says employees will still have the option to work remotely next week before Blackstone resumes its regular schedule on August 11th. And Delta said today it has no plans to use AI to set personalized fares for its customers. Last week, a group of Democratic senators suggested the airline would use the technology to charge individual prices. But Delta said today its ticket pricing does not take any personal data into account. I'll send it back to you guys.
All right. Thank you. Well, coming up, so much more to talk about on this big day for the markets. Tough talk on tariffs and tech earnings. It's still ahead on a busy edition of Overtime. Stay with us.
you